Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading weekend in June, June 18th, 2021. I'm Preston Brent, and thanks for tuning in. This week's theme is that a light at the end of the tunnel? We'll get into that in just one second, but first, what I want to do is just take a look at this past week's performance. Just kind of see how markets were stacking up around the globe. So let's take a look first at the U.S. markets. You can see everything was in the red for the week. Dow, S&P, Nasdaq, Russell, and the Dow really got punished this week. Nasdaq almost made it into the green, although we did see the best sector this week was technology, up 1.31%. But it's a little bit deceiving. Russell really got hit. Worst performing sector in the continuing saga of sell-offs in some of the commodities. The materials sector, which comprises a lot of commodities, down a hard 5.18%. Now, year to date, everybody's still in the green. We're still in a bull market. But if we look at the PE ratio, the forward PE ratio is still very high at 22.18. Dividend yield for the S&P 1.38. 10-year Treasury actually came in just a little bit, 1.45%. The spread between the 10-year Treasury and the dividend yield in the S&P is only 7 basis points. So that's going to continue to put money into the equity markets. And in the VIX, we had a big week. The volatility moved up 32 and almost a little over a quarter percent for the week, 32.26 for the week, closing out the week at 20.70. And then the best sector for the year, energy is still right up there. It's one of the few commodities that's maintaining upward momentum. Staples bringing up the rear this year so far, halfway through the year, at 4.98%. Now, if we look at it, this week was a really interesting week. We had a little bit of a hawkish statement coming out of the Fed's FOMC policy statement, and then remember they met on Tuesday and Wednesday. And then we had Jerome Boom Boom Powell's press conference on Wednesday, and basically talking about tapering. So he wants to drop that term. They are now officially talking about tapering. They moved up their dot plot from towards the end of 2023 into 2024 into interest rate hikes in 2023. But folks, understand something. The Feds have rarely gotten any kind of directional forecast correct. They're either over or underestimating, but they've never gotten it correct. So when I see a dot plot of potential interest rates hike 2 years out, I mean, it could happen next year, guys. Just understand that. We did see financials take a really big, larger than normal hit this week. I mean, they really got hurt. They were the second worst performing sector for the week, primarily because the yield curve actually came down a little bit, and finance really is big on yield curves. All right. Although this coming Thursday, after market close, the Feds are expected to release their results of the annual stress test for banks, and it's looking like it's going to come in flying colors. So that means the Feds are going to be reducing a lot of restrictions on stock buybacks and dividends for banks. And I can pretty well bet on Friday, given the larger move lower in financials, that I suspect we're going to see a bump in financials as we get towards the end of the week. Although the markets are really at a perilous time right now. Okay. So if we come in and we just take a look at the economic data, the summary of economic projections, it was released after the Fed meeting, as I said, shows the policymakers at the Fed, the governors, there are 12 of them that make up the U.S. Fed, the central bank, expect 2 rate hikes by the end of 2023. I think it's going to be sooner than that. They're going to be indicating a faster pace of tightening than their earlier projections. I can see it all happening in July and August. Remember, in August of this year, they meet in Jackson Hole, Wyoming. And that's traditionally the time when all the muckety-mucks at all the central banks get together and they talk about what they're going to do for the coming year. And I believe it's going to be probably a hawkish statement, because the Bank of England, the BOA, and the ECB, European Central Bank, they have already been talking about cutting tapering. So the Feds have now joined the party. So we're going to see how this works out. Now, a really interesting price action Friday, literally in the last 10 minutes of the market, actually the last 5 minutes to be exact, or 6 minutes. We got an interview from the St. Louis Fed President James Bullard, who's going to be a voting member of the Fed next year, and that probably helped drive the markets lower because he came out and said I could expect a rate hike in 2022. So we're already starting to get a differential between the 12 voting members of the Fed. And if Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, if they can't control, or if he can't control those Feds, we could see him outvoted. But that's unlikely. But we could see inflation coming in stronger than everybody expects, and a rate hike in 2022. But the minute he gave that interview on a local business channel, market sold off an additional 20 or 30 points. We were down about 38 points about 8 minutes into close. And then by the time the markets finally went into close on Friday, after the aftermarket, the futures was down almost another 30 points, down to 70 points. It was really amazing. All right. Really amazing. Now, if we take a look at U.S. Treasuries and all of this mayhem with, moving rates up, when they're gonna start talking about hiking rates and doing all these things, you would have thought that U.S. Treasuries would be skyrocketing higher, but they did not. U.S. Treasuries were volatile. Upon the initial policy statement, the rates went up. Okay, and then they immediately came back down on Thursday. And some analysts are saying this would mean that the markets are going to be running flat, for growth is not going to be as strong as everybody thinks. Remember, we got more stimulus coming into the markets. We got possible tax rate hikes to pay for all this stimulus. So it's going to slow down the rate of growth of GDP, although we do get earnings coming in about 3 weeks. We start with Q2 earnings. They're going to be out of the, they're going to be just record-setting growth, earnings per share growth. So let's see how this thing plays itself out. But there's going to be this big thing on transitory inflation versus non-transitory. And as I told our members, some of the inflationary items hitting they're not sticky. They're probably dissipate a little bit, like some of the commodity prices, but others like rising wages, those are sticky. And that's what the Fed's going to have to deal with. Okay. Now, if we come over to Europe and we look at the European index, you can see here everything was in the red with the exception of the Nikkei, the Japanese markets. But in Europe, everything was in the red. Okay, the DAX, CAC 40, FTSE, the Euro stocks, which are 50 of the largest companies across Europe, everything in the red. But everything's still solidly in the green year to date. So we're still in a bull market, even though we had this down day on Friday, and a little bit of a down week. China is in the red for the week, third week in a row that they finished in the red. Year to date, they're just barely hanging on, just above zero, at 1.5%. Hang Seng, Hong Kong index in the red for the week, but in the green year to date. Okay, shares in Europe. We're seeing inflation start to, not only in the U.S., but UK inflation is jumping up on higher prices. We're seeing industrial production in the Eurozone. It was stronger than expected in April, rising 80 basis points to a 39.3% year-over-year growth. But keep in mind that comps from last year are almost zero, so that's why we're seeing these big things here. So the big fear in the market is inflation, guys. And we just have to get that in our mind, that we're going to be watching economic data hit on Wednesdays and Thursdays when we get PMI and CPI data out. If inflation is higher, we're going to see markets really just react, I think, unfavorably to it. So we got to watch that very closely, all right? Just very closely. Now, if we come over and we take a look at China, China, as I said, they're the third week in a row where they finished in the red. Year to date, they're just barely hanging above zero. And the Hang Seng, of course, in Hong Kong is just up a little bit stronger. But again, very weak. China is actually been cutting back their stimulus longer than either Europe or the US, which I guess would make some sense because they kind of felt the pandemic first. Hell, they started it. But we are seeing out of China, retail sales grew at a below forecasted amount, which is unusual for China. Their economic data is showing the growth momentum, or the momentum in their growth is slowing just a little bit. Meanwhile, in Japan, exports rose almost 50% year over year in the month of May. mostly due to the U.S. buying a lot of Japanese exports. So um, we're all of this, folks, is setting up for just some higher inflation, right? Just really, really higher inflation. Let me switch over. I want to show you some charts here just to give you an idea what's going on here. Let me just switch this screen over here. I'm going to go take a look at the E-mini S&P 500 futures, just kind of show you where things are stacking here. And if we look at this, you can see, I'm going to give it a chance to come up on the screen here for you guys. It takes a couple of seconds to repaint the screen. But if you look at this, you can see here that big bar was on Friday. This is a daily chart. You can see that red line, which is the 50 EMA. Every time we've closed below it, the very next day we move back up again. And this goes all the way back to the beginning of the year, actually into the beginning of November. So you can see here we've actually fallen below it again. We've done this before. So the next day, which would be Monday's open, and more important, Monday's close, where are we going to close? Right? We've only closed one day below the 50 EMA going back to early November of last year, just one day. And then the second day, we've always moved back up. So this is going to be key on where we close on Monday. The next stop off point was the lows that we made back on the low of the intraday on the 13th of May when vol spiked up to almost 30, with these 3 hard down days here like this, right? So that would take us down to 40.29. If we take that out, we're coming down to this area down here. Now, I am on record as saying I think the markets will pull back anywhere from 7 to 13% sometime in the summer months. And I said June, July, or August. More likely July, August. Because remember, in July, we're going to spend the next 4 weeks, the second week in July through the second week of August, getting Q2 earnings. And if you would think, well, why would the markets pull back 10% if the earnings are out of this world? Just huge growth. And a lot of it is not going to be paying attention to the current Q2 over Q2 of 2020, because that was comparing it to like when all the lights were turned off. You could just sneeze and have a strong return year over year comps. What they're going to be asking and looking for is signs of inflation for each of those companies, as well as what's their forward forecast, right? And if that's pulled back because of inflation and higher anticipated interest rates, the markets could react negatively to it. So if I just give you an idea of what would a 10% pullback look like, well, let me just get that off the screen. I'm going to come back here and just change it to a price ruler. And let me just show you right here. So a 10% pullback, let me get a bigger one on here like this. So I'll move it up a little bit here. So if we look at this right here, you can see that right down to the open around 12%. Notice here that is the first major catch zone for Fibonacci. This Fibonacci is off the March 23rd lows of 2020, or March 23rd lows off 2020. You can see here it would take us down, and we would still be in a bullish market if we pull back 12%. I personally think that would be a good thing for the markets. Let's clear all this out, and then that would allow a strong finish into the end of the year. Remember, I had forecast 41 to 4,300 through the end of the year. All right. So now, and I told our folks, our members in our chat room, I said, let's watch how we close the market on Friday. And boy, was it an ugly close. Just to show you, let me just come back in. I'm going to do a 3-minute chart. And I'm going to show you. You can see right here, we were going into close. This was at 3:51 p.m. and the markets closed at 4. And the market, the E-mini was at 4170. Oh, let's call it 4171. It was down about 38 points. And then from that point there into market close, it closed at 4150. So it gave up 20 points in 6 minutes. And then after close, the futures continued to sell off. And then we made it a 70.50 down day after markets closed. It was really ugly. Okay. And of course, if we look at the Dow on this 3-minute chart, you can see same thing here. It was the same across the board. All right. It was ugly all across the board. And that was when Bullard came out and said, I could see a rate hike in 2022. So folks, just get used to this. If they hike sooner or they're more hawkish in their statements, you're going to see some pretty fast sell-offs, because our price to earnings ratio, our PE ratio is fairly high. Okay, so this is the movement that we could expect. That is one of these things that I would not be surprised to see in the markets. So this is the Dow. You can see the Dow also gave it up. Now I was talking about a bearish divergence in all the markets. And I said, this is something that we got to be very careful of. And you could see how in the Dow anyway, we're well below the 50 EMA. Okay, the 200 EMA is sitting at around 31,142. Would not be surprised to see us come down and test that. The next support level in the Dow is around 32,000, roughly. Okay, so that's kind of what I'm looking at there. Now, of course, if we look at the Fang Index, large cap, big stocks, you can see here that they're really very strong right now. Because interest rates, guys, have been coming down. And this is what's confounded some traders. Okay, if we come down here and just take a look at the 10-year rates right here, you're going to see here the 10-year rates on the last 2 days of this week came down, right? And we're testing this support area down here. Now, I'm still on record as saying I think the rates are going to come back up and finish the year around 1.97%. This is just an extended Elliott Wave 4 pattern, and it's most Elliott Wave 4s are not very pretty. I think we're going to eventually make our way back up again, but it just caused a lot of selling here, okay? And that is what's been hurting the finance, right? It's been hurting finance and the financial sector and banks, but it's been helping technology. When this reverses, we're going to see technology go the other way again. Just understand that. All right. Bond markets, they go in the opposite direction of interest rates. And I'm on record also as saying I'd love to see this get up to the 200 EMA, and then I'm going to be shorting bonds. That's something that we're going to want to do. All right. We're going to want to short it. Now, of course, if we come in and I want to show you financials, just show you just how much they got hurt right here. You can see on this daily chart of financials, we've blown right through the 50 EMA. 200 EMA is sitting at 31.69. This is XLF, the financial sector. You could see down here it held up very nicely, but this was the first major breach going back this year, this entire year, and we breached it pretty hard. So typically when you have a break like this, the momentum is going to possibly slow, and then we'll see a retest of the 50 EMA, and if that does not come back up above, then we got more downside that we can expect there. Okay. And if we look at the commodities, or first let me show you the dollar, because the dollar is what's killing the commodities. If we come over here and we look at currencies, I want you to look at the dollar. This has been unbelievable. Now, dollar was one of the most heavily shorted currencies out there, and you can just see it is straight up to the moon. Now, when you have a dollar moving up like this, you can pretty well bet commodities are going to get hurt. Okay, and if we just come in here, let me just show you the ag market for a minute. If we come in here and look at agriculture, if we look at soybeans, look at that, all just gave up the 50 EMA, and then we just came down like a waterfall. If we look at corn is coming in here, and it's just coming down, gave up, it's just falling down pretty hard here with corn. And then of course, if we look at wheat, you can see wheat also is coming down hard. And then of course, if we look at lumber, lumber, and if you've been to Home Depot, the lumber prices have given it all up and coming right back down again. So that has a tendency to cut some of the commodity prices. Of course, if we look at some of the other softs like sugar, you can see sugar is down. If we look at cocoa and chocolate, you can see that's just been working its way down. So these things have just been coming down pretty good. Now, the only commodity that is just showing strength and resilience is oil. And you can see here, oil is at near a 2021 high, which it made last Wednesday. Now, I've been telling our members, you want to be setting up range-bound trades here. I don't see not much more height in the oil trade, right, from here. I just don't see it. So setting up broken wing flies and condors with called condors makes sense to me, okay? Now, if we look at gold, this commodity, this precious metal got crucified. with that strong dollar. Look at this. It just waterfalled right down. I think it's going to find some support here, eventually consolidate and move higher, but it's a very pain trade with dollar moving higher, right? The other one that just got killed, which has very been bullish for quite some time, is copper. Copper came and finally broke this upsloping trend line. And this goes all the way back to April. We got in back here long. I kept people long until we pulled back here, and then we got long again. But this has been a very choppy trade right here. I do believe copper is eventually going to go higher, but for now, well, it's not going to be. We're playing this back and forth rhythm here with inflation, no inflation, global growth versus no global growth. One of the main things that dropped copper down was the statement out of China that basically said we're going to release some of our reserves in iron ore, zinc, aluminum, and copper. And that's like the strategic reserves we have in oil. You release them, it drives the price down. And China, since they are one of the largest buyers of copper globally, they are the largest buyer of copper globally, then you can see that this is just another reason why copper just came down hard. Okay. So this is what's going on in the commodity market. And then, of course, if we look at DBC, which is just a general makeup of about 23 different commodities, this ETF, you can see here we're now down touching this trend line. Okay, you can see the trend line on DBC. I want to look at that to see that it holds. It's fallen pretty hard. Oil is part of this too, so it's kind of a contra to the rest of them. But when you have a very strong dollar, it is really near-term hurt commodity prices. So that's going to have a tendency to rein in some of the higher inflationary rates. Okay. So, and then of course, if we come over here and we look at VIX, right here, you can see on Friday it was up almost 3 points. We're back into the light red color here, which is more of a very choppy type of market. We've hit this bottom here around the 15.5 area, and then every time we hit it, we just bounce up hard. Okay. So that's a little bit about what I'm seeing in the markets. Let me just see if there's anything. Oh yeah, one other thing I want to show you. I showed you Dow is down really hard. Look at transports, guys. Transports have broken down just like the Dow. So if we've got a breakdown in the transports and we got a breakdown in the Dow, is that a sign of worse things to come? We got to watch it very closely. If inflation is more sticky than transitory, then you're going to see the Feds get a little bit more hawkish than they even are right now, and that is going to move the markets down even more. Okay, we're going into the summer months where traditionally we have lighter volume, a little bit less liquidity in the markets, less trading, so it tends to move price action down a little bit further. So I am still sticking to my 7 to 12% pullback, 13% pullback sometime in these summer months going into September. Remember, since 2020, in March 23rd in 2020, we hit our low point in COVID. Since that point, we've been rocketing higher. We've had about 6 or 7 pullbacks greater than 5%. Okay. And the average pullback has been 7.5, roughly 7.5%. So an average pullback for us, and we've had 6 of them or 7 of them already. So another 7.5, 8% pullback is very easy. And if I just take a look and show you what that would look like on the E-minis, right, on the S&P, where would a 7%, let's say 7.5% pullback look like? Where would it take us to? It would take us right down to right about here, right around 39.50, right? That would be, and remember, we almost got there in early May, right? We had a pullback to about 40.20. But, right in that area there, about a 7.5. Now, typically when things get running, the momentum just carries it further. So from 39.50, it's not a very easy stretch to get us down to 3900 area. So that to me is what I'm expecting at a minimum. But I would not be surprised to see it run up just a little bit more than that. Okay. So that's what we're looking at here, guys. Bitcoin also ugly, ugly, ugly. I think Bitcoin is nothing more than just in a long consolidation period after this big run up here, and then I think it'll eventually make another run. Not sure if it's going to get up here. Really, the only way to trade Bitcoin now is just using technical patterns and support and resistance points because there is not a value established to it. It's whatever people want to pay. So Bitcoin could just as soon be 100,000 or 10,000. But you've got to follow the patterns because it shows you where people are buying and selling and what they're willing to buy at or what they're willing to sell at from a price level perspective. Right now, we're sitting on the 200 EMA. I think it can run a little bit lower. In fact, I'm projecting somewhere down around 28 to 27,000. But again, just a long consolidation period before it moves higher. That's kind of what I'm seeing right now. All right, everybody, that's it for our members. I will see you this Sunday night. We got a lot of cool stuff to review, and we'll see where markets want to take us for next week. Remember, Monday's open or Monday's close is going to be really important for the E-mini. We want to get back up over the 50 EMA. If it closes below, then we expect more downside. Okay, that's kind of where I'm looking at it. All right, everybody, have a great weekend. Members, I'll see you this Sunday night for our weekly market watch. Take care, folks. Ciao now.